Hey, what up guys? It's your boy Nick here, and all I have to say is wow. That's really all I can say. The stock market has basically been in freefall mode over the past month, and this is actually starting to spike some somewhat realistic fears of the 2020 recession beginning to happen. In fact, there was so much volatility and downward pressure on the market early this week that it actually hit a loss threshold in the first hour of trading on Monday. This ended up triggering a circuit breaker to halt all trading across the board in the stock market for a total of 15 minutes, and this would allow investors to calm down essentially and regain their thoughts if they actually wanted to sell their stocks. And to be honest, I didn't even know that this could happen in the first place because it simply has not happened in the time that I've been investing over the past 2 years, so needless to say, I was pretty shocked. But to summarize, all of this negativity piling up from the that shall not be named, but you all know about, and then the crash in oil prices that recently just happened because of the OPEC deal not going through has caused panic and fear in investors globally. And this of course has led to all of the red that we've been seeing in the markets lately, and it likely will not end soon. However, as investors, there are a few things that we do need to understand when navigating through tough times like this, because it's absolutely critical to keep a clear mind and not do anything stupid, for lack of a better word. And so there are 3 simple ideas that I want to discuss with you guys in this video today that will help you handle the pain of a recession period and actually know how to navigate through one and make way better investing decisions. And if you're a new investor, I can almost guarantee that you're going to feel somewhat better about the position that you're in right now despite the markets doing so terrible. So if you do enjoy this video, make sure to give it a big thumbs up to support my channel. It really helps out. And if you haven't already, definitely consider subscribing for more weekly videos just like this. And with that said, let's jump into these 3 tips to help you navigate through a stock market crash. Alright guys, now the first tip that I have for you here today is designed to help you better handle your emotions. As we all know, whenever the stock market goes up or it goes down quite a lot, it ends up leading to strong emotions, and in the current case, it ends up being fear and panic. And if you're new to the stock market, it's really important to know that if anything goes bad globally or in the media or in the stock market or for a company, it's usually fear and panic that guide their decisions. And of course, this ends up leading to heightened volatility because people want to get out of their positions very quickly, so they end up panic selling, and that's what drives prices down very quickly. But if you're a long-term investor like I am, it's very important to know that these 2 emotions, both fear and panic, should not be providing the basis for your investment decisions. Because what you need to know is that fear and panic and emotions are totally short-term. Everything is temporary when it's really bad and highly volatile in the markets. What I like to do as a long-term investor is to look at my portfolio on a long-term basis and then think about how this current scenario is going to affect my goals in the long-term future. Like really, if we see a 10% drop in our portfolio today, it could just as easily rise back up over the next week or the next month or the next year. And if we're selling in 20 years, why does it matter? It is purely emotions that get us caught up in the short term and looking at our portfolio values drop because it looks like we're losing money, but we're actually not. If you're a long-term investor, it's likely that you've been buying amazing companies with great track records, great dividend payment histories, everything of the sort, so you should not be worried about what happens in the short term. Sure, your portfolio might take a hit over the short term, but if you don't need to sell for the next 10 or 20 years, why does it really matter? So guys, one of my best tips is to honestly not even open your brokerage account, because this will elicit even more fear in you when you see how far down your portfolio's dropped, and I can definitely attest to this. It's also very important to try and avoid negative media, like watching a lot of these stock market news channels on YouTube, because they can elicit a lot of fear. So basically anything unconstructive like watching the news or looking at your portfolio or watching stocks drop 10% plus in a day is very unconstructive. It will not help you over the long term, so why even bother with it? And as we all know, fear is going to lead to further bad decisions, so it's best to try and avoid all of the negativity, avoid all of the news in the short term, and focus on your goals in the long term. And guys, another thing to help with your emotions is to actually realize that bull markets last a lot longer than bear markets. So what we're experiencing right now might only last maybe 6 months to a year to 2 years, and that's based on historical data. And that's what helps me get through these periods of high volatility. I actually started investing just before the crash in December of 2018, where the market dropped about 20%, so we actually entered a bear market. But I made sure to keep that long-term mindset, and soon enough, we actually got out of it much quicker than expected, and things rose even higher from there in a longer bull market. So being able to take advantage of that first tip and controlling your emotions is absolutely critical during a period of a market crash. And then the second thing you want to do is start focusing on your cash flow and your expenses and your income. Although you might not be able to control what's happening in the market right now, there are two things that you can control personally to benefit yourself financially, and those are to reduce your expenses as much as possible, and then secondly, to save as much cash as possible. If you have a job at the moment and you have a steady source of income coming in every single month, then you're actually in a very fortunate position. It's absolutely critical, in my opinion, to continue working hard and making sure that you can keep that job during such a difficult economic time, because it allows you to save a lot more money during this period, and that way you'll get through it a lot faster and be able to take advantage of opportunities in the market. And to be honest, in a tough time like a stock market crash, I would not be thinking about quitting my job to try and go for another job or even starting a business. I would simply want to build up my cash reserves to the point where it's sustainable and I can actually start deploying this into the market. And to be able to reduce your expenses to the point where you can still live comfortably but you're not spending much at all, this will allow you to save up a ton of cash very quickly. Because really the expenses is the only part that you can directly impact very quickly in your life. It's tough to start building more income immediately, but you can reduce those expenses immediately and start saving a lot more money. And just for your reference, I've actually made some videos in the past that will help you reduce your monthly expenses to save more money every month. So that is a critical thing to do right now. So make sure to give those videos a look. So if you can save up a lot of money by reducing your expenses and keeping your steady paying job, the next step is to be able to deploy all of that capital into great businesses on a discount. It is really not often that we find these great buying opportunities in the market. As I've said before, if we look at history, bull markets have lasted a lot longer than bear markets, and it's actually quite uncommon to find a bear market, especially in recent history. But I personally believe that anytime the stock market is nearing a 20% drop in prices from its all-time highs, it's nearing a pretty good buy. And that is because this is the critical mark for entering a bear market, and anything below 20% will be considered being in a bear market. So as you find the stock prices dropping of solid long-term companies that you've analyzed before, like McDonald's, Johnson & Johnson, 3M, start buying the dip. And if the stock prices continue to drop lower, who really cares? You still got that business at a really good discount if you did the analysis, and this is just presenting a better opportunity to buy it even cheaper. The way that I see it is that whenever I make an investment decision, it's based on the current time. It's not based on tomorrow. It's not based on a month from now. It's based on the price that I see it right now and if I think it's a good deal at the moment. And if the stock price drops lower, it's just presenting a better opportunity for me to buy at a discount. And it can feel extremely scary buying into a stock as it goes lower, because you're actually building up your position in that company, going heavier and heavier as the stock price is going down. But that's why in a recession, it's very critical to pick the dream team, as I like to call it, the best stocks of your portfolio and the ones that you know are going to survive through that recession and that you're just going to get on a discount that will eventually rise back up. The dream team companies have business models that are resilient and that are supposed to last through corrections and market crashes. And as you'll find, once the stock market crash is over, the pessimism leaves the market and then the optimism starts flooding the market. This will serve you with some insane gains. But it's important to keep in mind that this is only temporary. The stock prices will only drop for a certain period of time until they hit those support levels that are absolutely critical, and then they rebound off from there. So whenever you get that sick feeling in the pit of your stomach because your stock just dropped another 10%, continue buying more if it's part of the dream team and you know that company is going to weather the storm. And that's basically all I've got. It's a very simple strategy on paper, but once you're in the market, the emotions definitely take control, and it's very important to manage those emotions and make proper investing decisions, not based on emotions. And guys, just to give you some insight into my portfolio and my thoughts right now, I am down big on some of my positions, bigger than I've ever been down on any stocks before. So that's honestly a scary thing, but it doesn't bother me too much because I know that these companies are going to weather the storm and that when we're in a bull market again, it's going to do very well. There's also no reason for me to liquidate my portfolio right now. I have no reason to take this money and run, so that's also reassuring. So I can just leave it in there for the next 20, 30, or 40 years or however long I want. And that way it'll produce insane returns in the long term, whereas it doesn't really matter what's happening in the short term. And like I said before, I do think it's a great opportunity to start buying in the stock market if it's down 20% or more off its all-time highs. And so that's what I'm going to be doing. And if the stocks drop lower, I'll continue averaging down. But yeah, this wasn't a typical video of mine, but I really wanted to get this message out because I think it's so important that investors understand this and realize this in a time that we're in right now. I was in the exact same position when I started investing and almost made some really bad decisions because of fear and almost sold my stocks at a loss. But I held it out and things turned out a lot better than I expected. So it's very important to continue buying the dips, holding for the long term, not looking at your portfolios, and just waiting it out, and you'll be totally fine. And so with that said, thank you guys so much for watching the video. I really do appreciate it. If you did enjoy, make sure to smash that like button for the YouTube algorithm. And then if you haven't already, definitely consider subscribing for more weekly videos on personal finance, business, and investing in the near future. And I will see you guys in the next one.